I hope you all have your seatbelts on for this wild and crazy ride with me through the adventures of tax planning. No, in all seriousness, your coffee is low. Good night. The people who are going to enjoy this are going to be Dave. It would be Jim if he was here. Dennis, maybe Chad. Everyone else just nod and act like they're paying attention. We only got about 9 minutes, 15 seconds left. All right. Every year, tax planning is hard. This year, harder than usual because we have a couple things that are coming into play with the American Tax Relief Act, the Patient Act, and the Affordable Care Act. So I'm going to talk about a few things. I gave a flyer out, or a piece of paper out with a couple of bullet points that we're going to talk about today. Some strategies. Some may be common sense, but sometimes it just takes that little push for you to acknowledge that it's there, like exercise and eat less. But the first one I'll talk about is sometimes it makes sense to accelerate your income. If you know for a fact that next year you may be getting high bonuses or you're going to get an increase in wage, it may be better to have some wages from next year come into this year. Ask for bonuses or wages because this year when you're in a lower tax bracket than when you know next year you're in a higher tax bracket. Accelerating deductions. We all know the more deductions we have, the less taxes we pay. Especially if you're meeting those threshold amounts. Those threshold amounts I'm going to talk about in detail a little bit later, but they're $200,000 for single, $250,000 for married. So yes, they're bringing back the marriage penalty we all had about 10 years ago. Some accelerated deductions you can take. If you're a sole proprietor, you have to pay estimates every quarter. The last estimate that you have for the state and the federal aren't due until January of the next year. If you pay your state deduction in December, you can count that as a deduction on your current year tax return. If you have installments on property, I know here in North Carolina, especially Wake County, your property taxes are due usually in one lump sum, but there are states and other areas in the country where you can pay in installments, either by quarter or semi-annually. By getting that last payment in December, as opposed to January, February of the next year, you get an extra deduction. Now, the next one I'll talk about is the threshold expenses. Those expenses that a lot of people don't get to deduct because they never meet those thresholds. The main one is the medical and dental. For as long as I've been doing taxes, this deduction has been, the threshold has been 7.5% of your adjusted gross income. In 2013, it's 10%. Meaning anything below 10% of your income, you cannot deduct. So bunch those expenses together, pay some early, or if you know you're going to go to the dentist, have that thing done in December as opposed to January, because once that new year rolls, so does the county. And also you have miscellaneous itemized deductions. That one has a 2% floor. The main things on these are tax prep fees, unreimbursed job expenses, and maybe some advisory fees. Those are the big ones for that. But bunching those up, prepaying advisory fees, or going on business travels 1 month early as opposed to the next month can really help you get over those thresholds. So now you can take these deductions, utilize deductions on your tax return. Just because you go over the threshold, it doesn't unlock everything. It only unlocks the amount above threshold. So if you make $100,000 and you want to deduct your medical and dental expenses, once you get to $10,000, then you can start deducting those expenses. So just because you get $10,001 doesn't mean, woo, you get a $10,000 deduction. You get $1. Okay? I want to talk about charitable contributions. Property, money, as well as stock can be donated to charitable organizations. Now, more likely than not, the fair value of the property you donate is what you're going to go take as a deduction. However, sometimes it does revert back to the cost. A great tip is if you want to give money and you have a lot of stock, you can donate that stock to the charity. One of the cool things is you get to donate it at the fair market value, and you don't pay tax on your capital gains. So you get a win-win there. You get to take the deduction, the full amount, and you don't pay tax on the money that it has made in the past couple of years. For those of us that have kids or that are approaching the college, you may want to strategize and pay tuition. Because of the American Opportunity Credit, they've extended this until the end of 2017. But since it came out, it always was going to expire next year. Well, it's been extended since 2017. This credit's pretty cool. As long as you're below the threshold limits around the 175, 185 mark, you're able to deduct 100% of the first $2,000 of your child's education. Then you get to deduct the next 25%, the next $2,000. Maximum credit, $2,500. Now, for those of you who don't know, there's a difference between a deduction and a credit. The deductions that I talked about earlier, the taxes, the medical, the charitable contributions, that reduces your taxable income, which then creates tax. The credits, those are dollar for dollar deductions against your tax. So once you have a credit, you don't pay the tax. When you have a deduction, it reduces the taxable income you have to get that. Now, I want to talk about two main energy credits that have been extended. One is the non-business energy credit, and thanks to the American Tax Relief Act, this has been extended through this year. Again, this is one of those that has been. We're not going to do it next year. We're not going to do it next year. They keep extending it, and that one is where you get to take 10% of the cost of installation, windows, doors, and some biomass stoves, as long as they have an energy efficient level of 75%. But you get to take the 10% credit against your income tax. Now, there are some limitations. It has to be in a home located in the United States, and it cannot be a secondary home or a rental home. And there's a lifetime credit of $500. I mean, if you've already received it in the past, you cannot get it again. Now, the more cool credit is the residential energy efficient property credit. This is the solar, the geothermal, the wind turbines. This credit is 30%. Federal credit, 30% of the total cost, as long as the installation was complete by the end of the year. This can be done on the primary residence, secondary residence, does not qualify for rentals. And it does include, like I had mentioned, the solar properties. Also, we can talk about it later, there is a 35% state credit. So these things are expensive, usually between $35,000 and $70,000. But you can get a 65% credit on your tax returns. Talk about additional Medicare tax. These are the two things that I really want to go into depth. This year, starting this year with the new acts that are coming into play, the thresholds of $200,000 single, $250,000 married. Once your income goes above that, you will pay an additional 0.9% Medicare tax. Now, it doesn't seem like a lot, but every dollar counts. Now, the net investment income tax. That one is going to be an additional 3.8% on investment income. That's long-term capital gains, short-term capital gains, dividends. You're going to pay an extra. So for all those long-term planning with financial planners, well, let me have the long-term so I don't have to worry about paying the big tax. Well, your 15% rate just jumped up to 18.8%. It's a bummer. So make sure you utilize and get your financial advisor about, is this the year to strategize in selling all my long-term gains? You've got to make sure you're within those threshold limits before you just make those decisions. Or, better yet, net your gains if short-term with short-term losses, so you don't have to worry about that. Two other year-end planning moves that make a lot of sense, or that I like, and I know Dave likes, is contributing to your retirement plan. If you're an incorporated or non-incorporated business, set up a retirement plan. If you don't have one at your work, you can contribute to your IRA. That doesn't have to be done until April 15th, or even October, well, until April 15th. You can file your taxes in February or March, and then fund that IRA so you get your tax credit or your deduction earlier in the year. And then last but not least, Chad loves this one, it's the health savings account. This one's really neat. You get a deduction for every dollar you put in to your health savings account. The earnings grow tax-free until you pull that money out. However, if the money withdrawn is for qualified medical expenses, no taxes on your withdrawals. That concludes the tax talk. Are there any questions that someone has? Scott?
Under what conditions would the value of the real property use as a contribution based on the cost versus market?
Things such as collectibles, certain collectibles, and other various.
So if it's just raw land that would use the market value?
I would use the market value.
Isn't like a car, giving a car that change something?
Given a car, if you give a car that's worth more than $500, which is hard not to do, you have to do additional filing and get special reporting from the contribution. So, yeah, so they'll give you paperwork on the value of what, you have to report all your VIN numbers and all that stuff and file an additional return for the car, but it is a good deduction here to try to give away a car. Yeah.
Do you work in the requirements of financial planners?
I do. A lot of my clients use Dave. I refer to Dave a lot. We build a good relationship. I never step on toes of financial planners. I am not a financial planner. I can tell you about the tax today, here and now. But your financial planner, either he or she, has your goal for the next 15 or 25 years. Thank you very much.